Hello, everyone. Welcome to our leaders panel this year. We're very happy to be here on the 10th anniversary of Finance Magnates London Summit. Welcome, everyone. Welcome to our speakers. Thank you so much for joining us. Amazing panel we have here today after a whole year of ups and downs, unexpected trends. Crazy stuff has been happening, so we're going to discuss on all of that. I'm going to ask, first of all the speakers to introduce themselves briefly, and then we will start with a question. So maybe, Marc, you want to go first?
Okay, my name is Marc Bürki. I'm the CEO of Swissquote Bank.
Thank you, Marc. Wei.
Hello, my name is Wei Qiang Zhang. I'm managing director of ATFX UK and ATFX Connect. Nice to meet you.
Thank you.
Hello, hi, I'm Iskandar Najjar. I'm CEO of Equiti Group, financial brokerage house, multi-asset, multiple regulated jurisdictions as well.
Hi, I'm Charlie White-Thomson. I'm the CEO for Saxo here in the United Kingdom.
My name is Ralich. I'm the CEO and co-founder of oneZero.
I'm Matt Maloney. I'm the CEO of Finalto Group, covering our retail, institutional and technology businesses.
Thank you very much, everyone. So without further ado, we're going to start talking about the state of the market. I want to ask you all a little bit, what do you think is the state currently after the horrendous global market year that we have had, talking, not volumes, we'll get to that, talking about the state of the economy, the inflation rate, everything that has been happening in China with the zero policy, etc. So who wants to start?
Yeah, so I think it's a great question to start. I mean, my first view is that I think we're in a new paradigm. I think the Goldilocks period of the last 10 years is over. Cheap money, QE, low interest rates, that is now behind us. And as we look forward, I think we're in a new paradigm. And I think for investors, whether you're institutional, retail, to perform well in this environment, you need to understand that your portfolio has many gears. You need to think multi-asset. You need to think, how do I make money when the market goes down? And I think retail investors need to be very demanding of their wealth managers and their platform providers to get access to all of the gears of the portfolio. And on your inflation question, as I look forward, and unless you were an adult in the 1970s in the United Kingdom or you worked in an emerging market, you don't know what inflation is. And therefore, what I like to do is that I like to speak to my father and my father-in-law, who were alive and working in the 1970s, to fully understand that inflation is a hidden tax and what it does. And therefore, and I'll wrap up now, is that as I look forward, we are in a new paradigm. We should expect significant volatility. I don't think we've seen all of the impacts of the Ukraine war or COVID, and be prepared.
Thank you, Charlie.
Charlie, I'd echo that. I think you're exactly right. We're in an era now where there is still a lot of volatility. That, coupled with leverage, gives the opportunity for outsized returns on the upside and the downside, but they will be split across multi-product offering. The day of this just being an FX or a CFD business, I think, is probably gone. People want the full scope of services, the full scope of products, so that they can, to an extent, diversify. And I think that's what we will increasingly see in our broker community, that diversification of the product suite, of the technologies available, is what leads to outperformance in the broker space.
And do you expect high volatility in this market, considering the natural gas crisis we're having in Europe?
Yeah, without a doubt. I think fundamentals are really playing a role with volatility. They kind of lost their momentum, I felt, a few years ago, but now they're really having an impact on markets. You're seeing data points really moving markets more so than it had done a couple of years ago. Will it continue? Yes. I don't see a reason why not. I think we still have a couple of announcements before the end of this year, for example, which could move markets. You've got FOMC, you've got interest rates, really at the forefront of all the discussions. And then the FTX piece as well, and how that could potentially impact the markets. We still haven't seen the proper fallout of that. So from now till the end of the year, I think it should be quite active, and that would naturally spill over into early 2023 as well.
And do you expect the risk appetite to be reduced?
Sorry?
Do you expect the risk appetite to be reduced?
I think people are somewhat I'd say not on the edge, but reading the markets more carefully than they have done before. The swings are much bigger than they have been for some years. But there's also a lot of new players coming into the market. So volumes have increased, and we were able to see that, but of a more diverse audience than it was before. So risk appetite could reduce, but there's a lot larger number of players in the space.
Do you all agree? Do you have a different angle in your business?
I think I would agree for the volatile market and the risk appetite. I was reading something the other day. The risk appetite index from S&P become neutral now in November, like 0%. I believe the people are waiting for the news from Fed and the news from Bank of England as well, whether they're going to increase rate or not. There's different ideas. So I would expect high volatility in the coming month if some news hit the market.
I think inflation will ultimately come down. But there will be a lot of suffering until this is happening. I fear that next year will be really complicated. From as you say, the cheap money is gone, and now comes the we'll see. The companies that have a real strength and be able to survive in those difficult markets. It's true. We have lots of newcomers, but we have also a lot of companies that are leaving the space, and it's you have to be sustainable for next year. You have to have a business model that is resilient. I've heard this word very, very many times in the past few months. To be resilient in a complicated market is really the quality of a company and an organization, and we have to be careful with on the cost side, for sure. It's I've seen too many companies that have just you benefit from a trend, and then you go full in. You spend a lot of money, but then you have the smallest change in the market, and you're done. So I guess this doesn't apply to the old guys here on the on the panel, but to all the new companies. Just be very careful next year.
If I can.
Yeah. Andrew, you wanted to say something earlier?
Yeah. First of all, I had just had an existential crisis. Am I an old guy now? I never felt that way, but I think I've been categorized in the group. And in going through 13 years of this now, whenever there's an uneasy market like this, and we don't know exactly where it's going, probably up, probably down. Usually we like volatility. It tends to create opportunity. So I agree with all of the factors that are playing into this. What's very different right now, and what's really interesting from oneZero's perspective, is the employment market. So usually you'd be able to meet this opportunity with excess available resources, people looking for work, people looking to bunker up and prepare for an upcoming recession. And at least from our perspective in the US, it's still very difficult to find people. And not because they're not back to work, not because of COVID. Many people didn't come back to work after the pandemic. And the labor market just creates a very interesting angle to this recent instability or upcoming instability, because even if you've done well in the previous period, you don't necessarily have the ability to invest, go wide in people, and build up the defenses for it. So I predict a year of instability. I predict a year of a lot of partnerships and maybe even accelerated M&A in a downturn market because of the difficulty in bringing in resources that many firms are seeing.
Big diamonds are born under pressure, right?
I think just to add to one thing on this whole risk management side, I think that, as we all run businesses here, I think we have a responsibility. And our responsibility is to ensure that we provide access to multi-asset, all the gears of a portfolio that I said. But also, most critically, it's about leverage. I think excess leverage in these markets is a very dangerous thing. And at Saxo, we don't support over leverage, because I think that the end result for the client doesn't tend to be that good, particularly in these volatile markets.
Thank you, Charlie. Okay, my next question is regarding the leading European stock market. Crown used to belong to London, where we are today, but it has recently lost it to Paris. So what is your analysis on that, and what do you predict for 2023 and going forward? Marc?
Yes, so don't forget that it's also a result of the exchange rates, right? primarily, I would say. So if we don't give up 100% London, the city, to Paris yet. Even though the hard facts are coming. I think unfortunately the Brexit agreement with Europe didn't mention at all the financial markets, and I've seen lots of companies that are reducing their presence in the city, or at least not investing the same amount they would do elsewhere. So I wouldn't say it's not finished yet for the city. I still have good hopes, but certainly harder times are coming.
It's 1-0 to Paris.
That's exactly. It's not the end of the game yet.
Not minute 90 yet.
I totally agree with what Marc said. I mean, if you can see the leading brand in French market, all the brands my wife likes, luxury brands. But in the London market, we have energies, we have consumer related. So they're all hit by the potential tax and also the inflation hit low sales. I believe London definitely will be one of the most important countries for IPOs. But this year has been seeing slow pace. I believe we'll come back.
Yeah, I think London offers an awful lot more as well than just pure equity trading. It's the entire financial ecosystem. So English contract law, English language is widely spoken. The bankers, the accountants, the lawyers that sit behind the ecosystem are still there, are still powerful, and will still continue to see London as a powerhouse into the future.
On that side as well, I think the energy crisis played a role as well. I think France is 70% is reliant on nuclear power versus the UK at 15%. So that pressure really has played its toll. I think if you look at the AIM this year, it's dropped around 33% versus the CAC small around 22%. So all of these contributed to, as you'd mentioned, 4% down on currency valuation as well. But also, London has a history, and I think it's the people. The people in London, in order to capture that talent, we've tried to capture it elsewhere, but we've really only ended up growing our London entity, despite the challenges of working from home, despite the challenges that the country brings. It's not easy to bring everyone to the office in London as it is in other offices, but the talent pool is here. In order to access it, you have to have a strong setup over here. We've just expanded our offices here, for example. So we continue to see the trend in London for at least the next 10 years. Like I said, macroeconomic factors are playing into the impact of France taking the lead, but I think they're both at about 2.3, 2.4 trillion market cap. So it'll be interesting to see what happens on the impact of maybe easing on the energy crisis and all of those elements feeding into it.
Charlie?
Yeah, I mean, I may be biased, and I'm sure I am biased, but I think that the demise of the financial centre for the United Kingdom is much over discussed. I think that there have been the issues post Brexit, but I think we're in shakeout phase, and I would not encourage people betting against the UK as a financial capital and financial centre of the world. And saying that, I also think that if you think about here, the government and what they're doing is, I think that they have recognised too that financial markets are an extremely important part of the economy here in the United Kingdom, and things like reduction in surcharges for the banks, I think is a concrete example of that. So yeah, I'll start where I finished. I wouldn't be betting against the UK as a financial centre of the world.
I think the question becomes, London in the UK is a very important place to do business. It is a financial center of the world, but this specific question centers around the scope and overall market cap of the equities market, which means companies are doing business here, like oneZero and all of us. Are they organizing here? Are they running their mothership in this area? And I think that comes down to cost. It's gotten very expensive to operate in London, in a housing market, in a people market, going back to employment. So that's the real challenge here. This isn't a GDP question. This isn't is finance migrating away from London. It's an inversion of stock market value, which does have some currency exchange aspects to it, as Marc noted, but also it just means, are companies going public in this market, and are they choosing to keep their corporate headquarters here rather than use this as a satellite? And maybe that's the right thing for this city.
Okay, thank you, everyone. We're going to move into speaking about online trading, crypto trading, a little bit more in depth into the subjects. And I'm going to pick up on something that Iskandar mentioned before about FTX, the FTX saga. Don't we all want to know? Do you think that this is going to bring more regulation into the market? Is it going to be beneficial to the traders, or is it actually going to drive them away? What do you see from your perspectives of leaders in the online trading industry? Iskandar.
From my side, I think we've seen FTX, we've seen Three Arrows Capital, we've seen Terra. There's been a lot of noise around the lack of governance and the lack of regulation in the crypto space. I think it's only growing. It's going to start growing in demand by the retail investors, which is a very different conversation than it was on this panel 2 years ago. I think the size of the tickets are getting larger and larger. Temasek, for example, writing off 300 million on FTX. So the big ticket players have started to get involved, and there is no protection, there is no oversight. Even the most basic level of governance didn't exist at FTX. So as Marc had mentioned, resilience is key, especially with scale. And we've all witnessed this, we've all been through that. If you don't have the right governance in place, scalability, oversight becomes extremely challenging. So from a crypto perspective, I think the UAE is taking a lead with its own regulatory body. I think the Virtual Asset Regulatory Authority, VARA. It's launched 50 licenses under this MVP. To be able to test regulations and to ensure that it doesn't hinder innovation, because the biggest challenge of regulation is how much will it slow down innovation, and everyone is looking for innovation. There's a lot of great technology behind crypto on blockchain, but how could it be utilized outside of just cryptocurrencies, which made the most amount of noise? So I think finding that balancing act, but regulation is only going to grow within that space. Will it affect the OTC margin space? We've already been through that. I think the last 5 to 10 years has seen us completely evolve and change. Regulatory bodies have understood our business better, have made it a lot more complex, a lot more costly to be able to operate a large business. So will it have a direct impact? No, I think I personally see the focus being very much in the crypto space and further governance and further oversight within that space. Yeah, I think that's...
Well, the question is whether the collapse of FTX was the results of poor regulation or just a fraud, actually. And we don't 100% know yet. What we can say is that, look, take banking regulation. You know, it took years actually, and many scandals and many issues to come to the point where we are today. We may say that we are over-regulated as a bank, but at the end, you know, it's a result of all what happened in the past. And the problem is with not being regulated, you know, you just replicate what happens in the banking industry in the past. And that's the problem, and it's not really understandable for me why the various regulators would just look away, you know, say, okay, this is not something we are interested in, because we're speaking about billions of dollars of money lost to probably also retail investors, you know, and they deserve actually to have companies with a proper oversight. In Switzerland, and I credit to FINMA, they in the very beginning, they said, look, this is just a financial assets. You're holding these financial assets for the clients, so you have to obey to a certain number of rules. And the rules will be identical to what we are doing in the banking industry. You know, why should a Bitcoin be treated differently than any financial assets? You know, just basic things that you cannot just take the money of your clients and play with it. And you know, there was this interview that it just shocked me. You know, when SBF said, yeah, but everything was okay. You know, we had 24 times the daily volume, you know, so what's the problem? Say, well, that's not the problem, basically. You know, it's not about being able to serve daily volumes. It's about, you know, respecting the deposits of your clients, and then do proper things with that, have equity, and conduct your business in a proper way. And frankly, I'm super shocked by that. I didn't expect the collapse of FTX to be so fraudulent at the end.
I think, if I can.
I think it's relatively straightforward. We all run businesses in top-tier, proper jurisdictions. And why do we do that? Because that's where people trust their money is safe when it's invested. As cryptocurrencies become more ingrained and more mainstream, so I think there will be an increasing drive to embed a certain level of regulation globally, and that level of regulation will obviously vary by jurisdiction, but in the types of places that we do business and operate, so it will be a very high standard. And I think that is what will ultimately give people confidence to invest their money, whether they end up trading Bitcoin or Eurodollar or index products, it doesn't really matter. But there will be a convergence of business in properly regulated jurisdictions, and people can rightfully expect that their money is safe, that there is a proper segregation, that that there is regulatory oversight, there is periodic reporting, and things are visible and transparent, and that can only be good for people running businesses like ours.
The crypto industry, the proper settled spot crypto industry has a big problem right now, which is the fundamental drive and nature of the asset that they've manifested is self-settlement, self-clearing, and dodging regulation. We like being able to move our Bitcoins in and out of the exchange very quickly. We like being able to settle funds between each other without having to go through a bank. And now the crypto evangelicals are screaming, we knew this, we knew we needed regulation. The two are not going to converge. It's going to be interesting to observe. I'm glad we're not in that space directly. For our space, for OTC retail brokerage, I think this is the biggest opportunity that we've seen in over a decade. What happened to FTX? You generated and created this new segment of traders that didn't exist before. They have some slightly different criteria. They want to trade things that they understand better than what we've been offering in the past. They want to trade on weekends. But for those that want to speculate, the people who want to trade a Bitcoin and put it on a thumb drive and hide it in their mattress as like a funny store of wealth, they're not of interest to this group. But the speculators, those that wanted to buy crypto so they could sit down at the dinner table and tell their family, I'm invested in this new market, I understand it, are exactly who we've been trying to garner in for the entire existence of this space. And all of a sudden, companies came out and attracted a whole new base of clients. So at oneZero, our focus is, what did this? What attracted these people? How do we equip and enable an industry where we are a prolific provider of technology and back-end solutions to capture these traders, to get their deposits into regulated entities, to create instruments that they want to trade, like they got lured into the crypto space. And something I've been harping on for a few panels now is the weekend. We have to. This is our catch-up period. We've been given a gift. We got to figure out how to operate on the weekend, not just as a marketing exercise and sending an email to clients, how to staff, manage risk, build technology for the weekend. And this is our chance to do it. This is a big window for this industry, but we have to work for it.
I think the business model play a very key in this kind of situation. The current crypto market exchange world I can see some similarity compared to 20 years ago of our market, safety market. But we welcome the regulation. The regulation put us in a very compliance world, make the company like ATFX go a long way, because we follow regulation, we follow the rules. The rules teach us how to do business properly, not only to seek client deposit. We should have a healthy business model to grow our business in the proper way. And also, not only for governance, but also the marketing. How can you tell the clients the risk attached to crypto market? How can you tell them make your proper investment, and then think about that. Don't affect your personal life. Don't affect your kind of living standard. Don't think you're gonna make rich next day, like the news tells you. I think that's the regulation main part we need to focus on.
But you're both talking about the different nature of these traders and how to attract them and what was that attracted them. Don't you think that imposing a regulation now on these kind of assets is going to have literally the effect of them leaving this kind of industry? Won't that drive them offshore? Is it not the unregulated side of it that is attractive to them? The lack of bureaucracy, the lack of interminable KYCs, these sort of activities?
I don't think so, because there is this saying, not your address, not your crypto, and this is trending in the market. But the thing is, sooner or later, if you want to exercise your token and convert it into fiat, you have to go to a venue, and then I rather would have the money in a regulated entity in the UK or in Switzerland rather than in a country without any regulation, because I'm not 100% sure whether I can take my dollars once it's converted. So I think in the contrary, the more regulation we will have, or let's say if we just join the regulation with other financial assets, not make a difference just because it's a blockchain, then this will be a big win for the industry. I agree there are lots of opportunities, but I fear that it's not the end of the FTX story yet. You know, we're still at the beginning, and there's still 8 billion out there, and we don't really know, you know, where it will hit the market. But we know that it's 8 billion.
So how does the consolidation of the crypto market affect the risk management of the retail brokers nowadays? And what lessons have we learned from these from a risk management perspective?
I think so. The crypto market, in terms of hedging, is an evolving conversation. It's even FTX or some of the larger exchanges that are have reached what you would classify as critical mass, still have very convoluted order books, very difficult liquidity to manage and work with. So fortunately, complementing that has come two things. There's some great technology solutions out there that are normalizing that market to what brokers used to OTC trading and depth of market and interacting with traditional liquidity are looking for. There's also a good massive non-bank market makers. There are a lot of people out there who are capable of pricing in this asset. Granted, they might go a little wider with one less endpoint to hedge to, but the consolidation hopefully creates a little bit more transparency, a little bit less counterparty risk. You know, interestingly enough, in FX, there's a lot of things that can make our prices wide. We can have market volatility, we can have uncertainty, we can have macroeconomic events. Usually it's not counterparty risk that moves your spread. The consolidation in the crypto space should hopefully help the wonder for a jump or a B2C2 who says, can I actually get my money out of this counterparty? And that affects my ability to use or hedge on their price. So long story short, consolidation I think will be good there. There's a lot of work for them to do on their technology and how to present their order books to traditional markets, and the non-bank market makers should fill the gap.
Yeah, the fundamentals of the risk, I think, are probably the same. It's just the varying proportions that vary. You've still got credit risk, counterparty risk, market risk. They just vary, right? So we're all well versed in understanding those risks, measuring them and managing them on a day-by-day basis. We just need to take a slightly more holistic approach and understand exactly how much of the total risk in a crypto might be credit risk compared to the similar sort of amount of credit risk in a standard currency pair. I don't think it's fundamentally different.
Thank you all. So moving on to liquidity now on the OTC retail space, how has the liquidity and the prime brokerage evolved in 2022, and what can you foresee for 2023? Charlie.
Yeah, I think that's a very good question. I think that this is all about appetite for risk. This is all about counterparty risk if you go back to Archegos and things like that. And therefore, I think that the large prime brokers, the large liquidity providers are very much, I think they're very much stepping back. They are very much tightening their belts. And if I think a firm like Saxo, so we're 30 years old this year, you know, we've been working with our liquidity providers for decades. And I think it's about sustained relationships with them. It's about really working these, because if you put if you put yourself into the liquidity provider's shoes, a lot of this is about how they manage their book. It's about provenance. It's that, you know, they will be reviewing their counterparties on the whole time. And I think that makes it difficult for newcomers to come in. And that's just the fact of life, because what will be in the heads of each prime brokerage desk of these big liquidity providers is what happened at Archegos.
Thank you, Charlie. Wei?
Yeah, and personally, I have been through 3 times the wave of the PB relationship become a problem. There was a house crisis back to 2008. There's a black swan event. A lot of big banks, they have different view at different time. I think from my personal opinion, it's about the credit market. Because for our foreign exchange PB relationship with big banks, the profitability for the banks is a very small proportion. They are taking our business as more risk towards profit. When their portfolio becomes bigger and bigger, one of the brokers got problem, they probably cause the collapse of the whole business. I think they're more cautious when the business is growing. So I think it's another wave, but we do have a lot of reputable banks still stay in the market. I think it's a normal wave.
Yeah, I think the space is growing. There's more players that are looking for these services, and what's happened that's evolved. You start to create that prime of prime space as well. So what the banks have stepped away from, larger brokers have started to step into, and allow for customization of liquidity through them, and allowing those underlying clients to customize liquidity as well. So it's an evolving space. It'll continue to evolve. Banks seem to be stepping away. New banks started to come in. It's a constant change, and technology is allowing for brokers similar to ourselves and others in this space sitting on this panel to allow for prime of prime solutions and allow clients to access liquidity in different ways.
I think it's a great time to be a well-capitalized prime of prime credit and liquidity intermediary to this space. I think with pullbacks happening at banks, with tighter credit lines, and with even on the liquidity, not the credit side, banks being more cognizant that not all flow is created equal, and managing those relationships is more and more becoming a speciality. We service a very wide range of clients. We have purely institutional agency brokers who are fully outside of this space, engaging banks and hedging all of their flow, and we have retail customers that have never hedged once in their entire existence. I think what's important to understand here is when there is a credit crunch like this, or when PBs start to pull back, that means there is a segment of the industry that no longer qualifies for proper prime brokerage. And that's nothing against their business, their profitability. It's understanding that the bar has moved and changed. And going and sourcing liquidity in a different way, maybe commingled with credit, maybe not, is important to understand in those moments. I worry a little bit about a looming crisis in this space of there's always been this sense of having a direct bank PB, having direct bank relationships is some sort of qualifier. And it is to an extent, but it's not for everybody. And there's an emergence of a new concept of like a non-bank PB that started to make waves and reverberate through the industry that has some potential. But again, we have to remember there's reasons why banks' compliance desks and underwriters have such strict standards. And so going off and trying to bring in bank liquidity, if you're not at the right level, right balance sheet, right level of sophistication to do it, is the wrong decision and the opposite of a validator, and can cause some real issues.
I think that's exactly right. If I look at our experience at Finalto, we find that the depth and the longevity of the relationships with the LPs is very important. It's better to be meaningful to a few than have an enormous panel, each of whom gets an insignificant amount of business, and therefore you're not very important to people. We tend to see exactly what you've highlighted. Actually, there's a whole bunch of people out there that are struggling to get bank liquidity. The barriers to entry are getting increasingly high, and that presents a great opportunity for businesses like our own and like many others here.
Yeah, well, nothing really to add. I think it's a trend that we can observe since a few years now. So it's not something that happens in 2022. It's going on for the last 4 or 5 years, and the credit, the risk matrix of the big LPs has changed. No, and I agree. This is a great opportunity for retailers. You know, you can subsell the liquidity, and that's one part of our business model.
Okay, let's talk a little bit about fintech. It has been an unprecedented year in a side of the industry that is usually extremely stable and foreseeable. We have had one very particular hiccup that has put the relationship between business providers, service providers, and brokers to test. And I wanted to pick up your brains and ask you, what's your take on it? What's the impact on retail traders? Is this signifying a shift in the business models of the brokers going forward? Is this going to change how brokers generally operate? What's your take on it? Iskandar?
I guess there's advantages and disadvantages on having one provider versus multiple providers. The obvious advantage of having multiple providers is not having a single point of failure. But that requires scale, it requires operational efficiencies, and a lot of fixed costs to manage multiple number of providers. But it's a necessity, you know, especially as you scale as a business. You can't have a single point of failure to your clients. So it's not just a simple plug-and-play solution. It's very much dependent on what part of the process of your ecosystem it is. But as you scale, you have to, some elements bring in-house, some elements use multiple providers, but in an efficient and cohesive manner as best as you can.
Thank you, Iskandar.
I think taking the technology and front-end side of this conversation aside, I think the interesting thing that we're observing and trying to understand more in this situation is the role that the App Store played as a quasi-regulator in this case. A very interesting phenomenon where we've always understood regulation as a capital or asset-focused type body. Apple now in this case has taken a stance that they didn't like something going on in a financial app in their store and has decided to regulate against the technology provider. And it's interesting. It's unprecedented. It shows that there's a massive amount of power within these isolated ecosystems and app stores, and it brings pause as to how you would approach doing this differently in the future. I think that there's a lot of criticism to throw around in this case, but when we step back and look at it, we say, you know, what would oneZero have done differently in this case? Is it that every broker needs their own white labeled instance of something to go out, and that the era of the gray label or a technology conduit run by a technology provider into an industry on behalf of multiple brokers doesn't work? And what's interesting is, you know, when a regulator makes a decision like this, they publish their rules and we can read it. We pay lawyers a bunch of money to understand it, and precedents get set and we can react to it. These rules are unpublished, so we don't know. We don't know how to prepare for the next one. We don't know how to actually comply with this. And I'm sure, you know, the companies on either side of this are asking the same question. With every chaos or challenge like this comes opportunity, but this one's tough to understand because the rules by which this change was enforced are not clear. They're not transparent.
I think everybody was a little bit puzzled. Anybody wants to add something to it?
As a heavy user of some technologies in our industry, we do think there's a cost element. If we have an ecosystem, we can save a lot of money. But we also feared if some of these major providers failed, no matter technology-wise, but also compliance-wise, this side, we will have a problem. And things happened few months ago, happened on a Sunday. There's so many efforts we have put in place, not only because of the technology, but also because of the feeling from the clients. Are we going to have problems? Are we going to have problems with the broker because they are using this technology? I think with multiple providers will be healthy for us, but reliable ones.
I think for me, this is about resilience. This is about single technology stacks. This is about multi-asset portfolios, and being able to offer all of this in a resilient and stable way. And I think, as I think about our institutional business at Saxo, it's growing very fast because people want that. And when I think about what our partners are saying, you know, they're thinking to themselves, do I want to build? Do I want to partner? Or do I want to buy? And what I'm seeing is the most progressive CEOs that we speak to want a partner, because buying is expensive, building takes a long time, so partner automatically comes in. And I think that's the key driver. It's the resilience, it's the single technology stack, it's the multi-asset, but also that all needs to be done at a fair price. So this discussion that, you know, this race to zero on fees is not something that I support. It's not something that we support, because these businesses, as we've all alluded to, are expensive to run. And therefore, trying to do all this for free it's an oxymoron. It just doesn't work. So I think it's a really top-notch service delivered at a fair price.
Yeah, the best relationships are ones that are symbiotic, where there is a genuine partnership, where a client can take from a provider all or any element of the offering, and we're relatively agnostic to what you take and what you build into the system. You could get the best of all worlds that way.
Thank you all. We have only 6 minutes left, so I'm going to start moving on to conclusions. As interesting as our discussion is and more questions that we had, I'm going to ask you if you can please summarize for us what were the biggest risks and what are the 2023 biggest business opportunities for vendors as much as for brokers going forward. Mark?
That's a tough question.
Isn't it?
I think 2023 will be, it can't be worse than 2022, right? You know,
Never say never.
I think we had about everything that the market can give us bad news to the industry. I mean, we had the war, we have the collapse of FTX, we had the inflation, interest rates increasing. You know, there's so much uncertainties. For me, I'm quite positive in 2023 because there are potential good news in the market, right? You know, just imagine the war will come to an end somehow, or just the inflation will go down a little bit. Just imagine, you know, how positive this can be to the market. And we have seen a few signs, you know, just the hope actually that something is going to happen. You see. So I wouldn't sell 2023 too early. I think it will be a good year. We will have. I don't fear so much recession. I don't see it happening because I think someone earlier said that the labor market is still crazy. You know, we still have difficulties in finding talents and good people. And besides the risk of the inflation itself, I don't see the economy being in such a bad shape. So I'm positive for 23.
I'm glad to hear that. Charlie?
I think perhaps I will start where I finished at the beginning when we started speaking together. I think that we're in a new paradigm. I think that the Goldilocks period is over. I think the biggest risk for me is policy failure at the central bank level. And what I mean by that is how you thread the needle between quelling inflation, moving interest rates up without crushing the consumer and crushing the economy. And I think this is the key question to ask, because if central banks get that wrong, then I think that's a very difficult place to be. And though I'm a natural optimist, I think winter's going to be challenging. I think you have many challenges to deal with. You've got a cost of living crisis, you've got rates moving up. So I think we need to do with that. So that goes back to one of my core principles, which is manage your risk. And then as I look into 2023 and I look at my blotter, the thing I'm really grappling with, I'm trying to get my head around, is consumer duty. So this will kick in July. It's a major subject. It's a major subject for people like us to work with. It's, you know, how do you deal with that? What is a vulnerable client? How do you manage your MI? What is a potentially vulnerable client? What percentage of your clients are vulnerable? And I think that will be the major subject in my mind, apart from all of the other things that the market will throw at us. How do you deal with that? So at Saxo, we want to be top quartile on that. We believe it's the right thing to do. We want to do the right thing, but it's a massive book of work, and it's taking a lot of my thought process.
I think different company probably have different plan, different agenda. Marc was my kind of experiment person back to 5 years ago when we first time sponsored Financial Magnates. I told my shareholder, we won't be there. We want to be the CEO panel. Yeah, okay. Today we are here. So as a relatively young brand, people here, all our kind of teachers, and we will learn from them. I just came back from Mexico 2 weeks ago. There wasn't any energy crisis. There wasn't any food crisis. People are happy. People are strive for the business. So I think for ATFX, we think in 2023 will be full opportunity for us. We're going to continue to expand worldwide.
I think
Andrea, yeah.
With any period of challenge, which I agree, it's not a fun time to be a central banker right now, a very unprecedented period. But with those challenges comes incredible opportunity. But I think you hit the nail on the head, Charlie, when you said we're really going to have to work for this. This isn't a period of upcoming volatility where we can sit back and reap the awards on existing investments, existing partnerships, and technology. I've said it, I'll say it again. I think the weekend is very critical to this industry, and it's something that we can't sleep on over the coming 6 to 8 months as we have this opportunistic period to observe what happens in crypto, but also prepare for either an influx in demand or a resurgence in that space going after our client base. And it's not time to think about the weekend like a marketing exercise. You need people to manage risk. It's a difficult labor market, finding technology providers who have real weekend support. You know, speaking from bias, we've been doing this long enough that there was a period of time where you were calling Andrew on the weekend or I was sleeping next to a laptop. There are a lot of businesses that are still operating on that model, and it's not going to work through the weekend. It's not going to work in the future of this space. Just to finish off, the year of partnerships. I really believe that 2023, the challenges that are coming are happening very abruptly. The FTX bubble burst, the MetaQuotes App Store issue, they're not things we can prepare for. And in a difficult labor market, we can't hire or build out into this. It's a time to forge good partnerships, understand where your core competencies are, and have a good group of partners around you to be able to execute and react to whatever comes next year.
Yeah, I echo it. It's going to be a challenging year, however you look at it, on the macroeconomic level. But what will be unbelievably important, in my view, is that relentless focus on providing a quality solution to the customer at a fair price, whatever that solution might be. Whether it's making sure that you give the customer the very best tools to help them manage their own risk, whether or not it's getting the very best liquidity, the very best technology offering, the very best person to come and work at 9 o'clock on a Sunday evening. It's got to be that relentless focus on quality. And when you set that in the sphere of a war on talent, it's going to be challenging.
From my side, I think a recession is potentially looming. I think the housing bubble is yet to hit the markets, but that's going to create market volatility. We're geographically well distributed, so our client base is very global, similar to most people on the panel over here. So as you'd mentioned earlier, everyone is going through different levels of impact of the economy. Where the opportunity lies for us is similar to what Andrea had mentioned earlier. The fallout of FTX is a significant opportunity for us. People have an appetite for trading. Trading has become a lifestyle. But people have become more aware of the importance of being able to have the right counterparty and leave it only for market risk and remove the counterparty risk around that. So there's a new client base, there's a new audience that we can interact with, that we can speak to. It's about having the right tools, having the right technology to be able to communicate with them and allow them to trade what they need to. So it's a responsibility for all of us to be truly multi-asset, to diversify our product range, and to be truly global as well. Regulation is important, not just in the UK, but on a global level as well. So local regulation is important, local payment solutions is important, and to truly embed yourself within the communities that you're building yourself into. Not just having a front office, but really kind of adapt your product locally, adapt your payment solutions locally. Speak to your local communities in their language, and really be part of building that ecosystem in the geographies that you're based into. So I think that's much more of a long-term vision that we have. It's a 5 to 10 year vision, and allow everyone to trade with best-in-class technology no matter where they are around the world. So I think there's still tremendous opportunity in our space that 2023 will only touch on it.
Thank you all. Our time is up. I'm going to thank you all very much for coming and sharing all of your ideas. I hope that they have inspired our audience and everybody else that will watch it afterwards. I'm going to ask you a big round of applause for our experts.